Hello everyone, today I'll discuss HSBC's bullish stance on Hong Kong and their plan to privatize Hang Seng Bank. While countries raised tariffs, China became an observer state of the Latin American Andean Community, making inroads into America's backyard. US-China tensions are rising daily, especially since October 8, with 16 Chinese and Hong Kong companies involved. This relates to electronic component and drone trade distribution. China retaliated after the initial move. The Ministry of Commerce, Customs, and others issued 7 documents, tightening controls on rare earths, lithium batteries, graphite, superhard materials, and their redistribution post-export. China's stance towards the US is hardening, including countermoves in Latin America.
The Andean Community's 31st Foreign Ministers' Council recently voted unanimously to admit China as an observer state.
Analysts say that with China officially becoming an observer, it will strengthen its strategic foothold in Latin America and promote the development of industries ranging from artificial intelligence to electric vehicles in the region. The 4 member countries of the Andean Community are rich in gold, copper, and lithium resources, forming a natural complementary relationship with China. According to analysts cited by the Morning Post, the Trump administration kept raising trade barriers, and the US isn't truly concerned about the interests of other countries. On the other hand, Latin American countries want to sell more products to the global market, so they've turned to China, which is seen as a more reliable and stable partner. Roland, the founder of the consulting firm Lazarus Consulting, said that the message China is sending to Latin America is that, even though the US is shutting its doors and withdrawing, China is still keeping its doors wide open for business. The Andean Community was established in May 1969 in the Latin American region and is one of the major regional economic cooperation organizations, with its headquarters in Lima, the capital of Peru. Currently, it has 4 member countries: Peru, Ecuador, Colombia, and Bolivia. Chile and Venezuela joined in 1976, and then withdrew from the Andean Community in 2006. Although the number of member countries in the Andean Community isn't large, these countries occupy strategic locations. They stretch across the heart of South America, connecting the Pacific and Atlantic Oceans, and are exceptionally rich in resources. Peru is the world's second largest copper producer, while Bolivia boasts the world's largest lithium reserves. Colombia is a key energy exporter in Latin America, and Ecuador is blessed with rich biodiversity and agricultural resources. Even more importantly, the Andean Community is one of the earliest organizations in Latin America to promote regional economic integration. Its purpose is to promote trade liberalization among member countries, coordinate macroeconomic policies, and strengthen infrastructure connectivity. Although it may not be as large-scale as Mercosur or the Community of Latin American and Caribbean states, its internal integration is high and its execution is strong, making it a testing ground for regional cooperation in Latin America. Precisely because this organization is smaller, it is actually easier to implement cooperative projects with China, creating model projects. After China became a member, it participated in ministerial-level meetings and special dialogues of the Andean Community, connecting with Latin American policy circles, proposing cooperation initiatives, and sharing development experiences. China can align Belt and Road projects with the Andean Community, promoting new projects in trade, investment, infrastructure, technology, and environmental protection, forming a new cooperation pattern. Jiang Tianjiao, deputy director of the BRICS Research Center at Fudan University, said that as a major Asian economy, China's official accession to the Andean Community is also a key move in deepening the Global South strategy. By institutionalizing its participation in regional affairs, China has strengthened its voice among developing countries. At a time when Trump is launching a tariff war against countries around the world, China, as an important member among developing countries, has pledged to defend the global free and open trade order. By joining the Andean Community, China can help member countries offset the impact of Trump's comprehensive tariff increases, because these economies are now being forced to look for alternative markets. For decades, U.S. policy towards Latin America has been fundamentally based on the Monroe Doctrine, treating Latin America as its own backyard and not allowing other countries to interfere. In reality, the U.S. sees the Americas as America's Americas, frequently intervening politically and militarily in various countries, and is even preparing to invade Venezuela under the pretext of fighting drugs. The Trump administration's America First policy blatantly used Latin America as a tool, imposing heavy tariffs and draining resources. In contrast, China has never interfered in other countries' internal affairs or attached political conditions to trade. For example, China invested real money to build the Chancay port in Peru, constructed by Chinese companies, now the largest deepwater port on the South American Pacific coast. Colombia's first metro line in Bogotá was also contracted entirely by Chinese companies. The Mitten steel plant project in Bolivia has also helped the country achieve self-sufficiency in steel production. The General Hospital of Chon in Ecuador was built with Chinese assistance, greatly improving local healthcare conditions. All these projects are focused on people's livelihoods and development. China has carried out more than 200 infrastructure projects in Latin America, implemented numerous economic initiatives, and created over 1 million jobs. Secondly, China has opened its markets for trade, and for many years has been Latin America's largest trading partner after the United States, maintaining stable imports of resource products like soybeans, beef, and copper from the region. In 2024, trade between China and Latin America reached $518.4 billion, doubled from 10 years ago. China is Latin America's second largest trading partner. China became an observer state of the Andean Community, a dilemma for the U.S. If the U.S. remains silent, it allows China's influence in Latin America to become institutionalized. China could then use the Andean Community platform to encourage more Latin American countries to join the Belt and Road Initiative, join the Global Development Initiative, and settle transactions in renminbi, deepening a China-centric system undermining America's priorities. Conversely, if the U.S. intervenes, it must commit real money, adjust Latin America policies, and abandon its America First unilateralist logic. The U.S. would have to stop imposing high tariffs on those countries, otherwise who would listen to America? Trump keeps thinking about using punitive tariffs to extract resources from other countries. Is he really going to give it up? In conclusion, China isn't afraid of offending the U.S., so it's not afraid to get involved in Latin America through CELAC. CELAC is a breakthrough point, and China will continue to push forward in Latin America. The U.S. is losing support, and it won't be easy for them to break out of this deadlock. Besides, I'd like to talk about HSBC Holdings' proposal on October 9th to acquire shares of its subsidiary Hang Seng Bank at a premium, aiming to privatize Hang Seng. News shook financial markets. HSBC proposed to acquire remaining 36.5% of Hang Seng shares at 155 Hong Kong dollars per share, a 30.3% premium over pre-announcement price. Deal is worth 106.106 billion Hong Kong dollars, making it largest privatization in Hong Kong's history. After announcement, Hang Seng's share price surged, even surpassing offer price at one point, while HSBC's share price plummeted, dropping 6%. HSBC's share price drop dragged the Hang Seng Index down 135 points. The market lacks confidence in HSBC's acquisition, thinking HSBC is paying too high a price for Hang Seng's shares, not good for HSBC itself. HSBC reduced its stake, can use funds for share buybacks. HSBC's share price dropped. Hang Seng, acquired at a high premium, surged. After the acquisition, the most talked about topic was face-saving theory. Hong Kong's property market has been slow, and Hang Seng accrued large bad debts from developer loans. Market participants believe HSBC doesn't want Hang Seng's bad debts exposed. Thus, after acquiring and privatizing Hang Seng, issues can be dealt with privately, reducing Hang Seng's bad debts. The face-saving theory is flawed because HSBC is a listed company, and it's spending billions to privatize Hang Seng. Compared to Hang Seng's property loan bad debts, the amount is insignificant if the only purpose was to cover up bad debts. HSBC is a listed company, so it considers shareholders' interests, making it unlikely to spend a huge sum to dress up the books. Hang Seng owns valuable assets, like its wealth management business. HSBC is taking advantage of Hang Seng's stagnant performance and low share price to acquire its shares, taking over its high-quality wealth management business. This argument does make some sense, but it might not be the core of the issue. Hang Seng does have some assets of good value, but in the short term, HSBC is offering up to a 30% premium to acquire Hang Seng's shares, and that high premium has already fully reflected the concrete value of these assets. For a savvy investor like HSBC, of course they'd want to buy at a bargain, but paying such a high premium to buy in shouldn't be part of their usual strategy. On top of that, HSBC's own price-to-book ratio is 1.4 times, meaning its market price is 1.4 times its book value, or net asset value. Hang Seng's price-to-book ratio is 1.8 times. Buying assets with a higher price-to-book ratio basically means buying at a premium, and it also means that after privatizing Hang Seng, HSBC's own price-to-book ratio will be pushed up, making HSBC look even less cheap. So if HSBC's real intention is just to acquire certain assets of Hang Seng, it really shouldn't be paying such a high premium to do so. Reasons exist for offering a high premium. If HSBC's offer is too low, Hang Seng's institutional shareholders will oppose privatization, and it won't go through. This brings us back to the core issue. If the premium isn't high enough, the deal can't happen. But if the premium fully reflects asset value, from a short-term perspective, HSBC shouldn't make a move. When analyzing HSBC's actions, we should consider a bigger question. Why would an important global bank like HSBC make a massive investment of over $100 billion? They shouldn't just focus on short-term returns, but should consider long-term gains. Even if they know that making a high-priced acquisition might hurt the share price in the short run, if they're looking at the long term, they'd still think it's worth making a move. Back in the 1990s, due to political concerns over Hong Kong's future, HSBC relocated overseas, later moving its headquarters to London, and made major acquisitions of assets in the UK and the US. HSBC's misstep. By doing so, they gave up high-growth opportunities in Hong Kong and mainland China, pouring capital into the US and UK, low-growth or problematic markets. HSBC sold its US assets and reduced its London operations. Recently, they've shifted focus back to Hong Kong and mainland China. HSBC's move to acquire Hang Seng shares indicates strong optimism for Hong Kong's market long-term. They believe in Hong Kong's opportunities and Hang Seng's local business focus. Even if the acquisition price is high now, from a 10-year perspective, these assets remain quite cheap. Why they're making a move? HSBC is best equipped to assess the long-term value of Hang Seng's business in Hong Kong. So, they're using this plan to privatize Hang Seng as a way to make a big bet on Hong Kong, not just focusing on short-term stock price gains or losses. If HSBC wasn't optimistic about Hong Kong's long-term prospects, and didn't believe in potential as a financial and wealth management center, why would they invest resources into Hong Kong assets? If HSBC is bullish on Hong Kong, it makes sense for them to buy into Hang Seng. They know best. The most reliable, sure-win business. Besides, it's not easy for HSBC to find other high-quality financial assets worth over $100 billion for them to bet on. As I mentioned, among the three global financial centers, New York, London, and Hong Kong, London is out of the game. This year, its fundraising didn't make the top 20. But Hong Kong's fundraising ranked first this year. Hong Kong looks promising. I believe that after HSBC's move, more people will see development opportunities in Hong Kong and make investments here.